Let's Talk Accounting answers the question, what is? Removing the jargon of accounting, finance, and business. Shedding light on some of the jargon used, clarifying the jargon into everyday words you'll understand, and get a clearer view of what is happening in your world, building your confidence in the world of business. Let's get started. What is compound interest? It's interest paid in accumulated interest as well as on the capital invested. Increasing the compounding frequency of your interest rate, or adding to your principal, can all help your savings grow even faster. Next, what is the relationship of quality to cost? As the quality increases, the costs decrease. Due to the operation efficiency and development in quality management, the inspection cost is reduced and all other related costs, so the cost of the product decreases. Next, what is gross profit? The gross profit on a product is calculated as follows. 1. Sales minus cost of goods sold equals gross profit. 2. Gross profit divided by sales equals gross profit margin. 3. Selling price less cost price, divided by the cost to produce equals the markup percentage. Next. Number 4. What is commitment fee? Commitment fee is a charge made by a bank when loan facilities are established for a borrower. The commitment fee is a way of guaranteeing the bank will keep the funds available. This fee is tax deductible as a business expense. Next. Number 5. What is collateral? Collateral is property or assets made available by a borrower as security against a loan. Sometimes called security, collateral acts as a form of protection for the lender. Next. Number 6. What is break-even point? Your break-even point is the point at which total revenue equals total costs, or expenses. At this point there is no profit or loss, you break even. In investing, the break-even point is said to be achieved when the market price of an asset is the same as its original cost. Next. Number 7. What is current ratio? Current ratio is a measure of liquidity. It's the proportion of current assets available to offset the current liabilities, calculated by dividing current assets by current liabilities. Sometimes referred to as working capital ratio. Potential creditors use the current ratio to measure a company's liquidity or ability to pay off short-term debts. Next. Number 8. What is capital? It's the value of your investment in your house or business, represented by the total assets less total liabilities. The initial contribution to the business, and the wealth that it generates. For example, a factory and its machinery, intellectual property like patents, or the financial assets of the business or an individual. Next. Number 9. What is cash ratio? This is the amount of cash and easily marketable securities held by a company as a proportion of its current liabilities. Creditors prefer a high cash ratio, as it indicates that a company can easily pay off its debt. There is no ideal figure, a ratio of not lower than 0.5 to 1 is usually preferred. Next. Number 10. What is the capital gains tax? It is a tax on income, the gain, arising from changes in the market value of assets. A capital gain is calculated as the total sale price minus the original cost of an asset. Next. Number 11. What is capital gain/loss? It's the result of selling a capital asset at a higher or lower price than it cost. Capital gains are profits or loss derived from selling an asset. For example, financial investments, real estate, personal property, or collectibles. Next. Number 12. What is capitalized expenditure? Expenses carried forward in the balance sheet as assets, to be matched against future revenue. Capital expenditures, referred to as CapEx, is the money companies use to purchase, upgrade, or extend the life of an asset. Types of CapEx can include purchases of property, equipment, land, computers, furniture, and software. If you don't know what you're doing, it's a jungle out there? This completes Chapter 1 of Let's Talk Accounting 101. Watch this space for Let's Talk Accounting 101 Chapter 2.